With oil, following the risk-on rally on Friday after non-farm payrolls miss on the headline, it has started to um, correct on Monday, the initial balance for the week. We had this head and shoulders sort of a dead giveaway that the price was destined to move higher along that trend line, but it's come up into what might be regarded as a resistance area. I say area because I'm including all of the past structure right until the end of April. So this sort of scenario here. Now, what we haven't seen on Monday is a particularly significant correction of that impulse. It didn't make a 38.2. I like to see the price come into at least the 38.2, and it hasn't done so. Therefore, I'm not sure that there's enough demand in that move in this correction. I'm not sure if it's attracted new money. Instead, it could be about profit taking, and we've got a market that's sort of indecisive at the start of the week. We've got some US dollar strength coming through, which is likely weighing on the price, and risk sentiment is a little bit off as this non-farm payrolls data has been digested, leaving the path open for further rate hikes. So while the stock market um, is poised to move up, um, it's making hard work of it, and I think we're probably just going to swoop back in and move sideways until we've got the CPI data coming out and various Fed speakers. Now, with regards to the industry itself, supply risks have been offering support to the market, with Saudi Arabia that's rolled over its voluntary production cuts, and Russia's decision to curtail exports um, is likely to support the market. But technically, well, we could see this sinking back into this Fibonacci zone, and we'll have likely support back at old resistance. So if I just mark that in, between there and here, so pull that range in. So the 61.8 looks vulnerable around 72.20 on the downside. That's so long as the initial balance on Monday and Tuesday, we might have seen the high. If that's the high for the week, or at least until midweek, then the prospects are towards 61.8 Fibonacci, 72.20. And if we go down to the lower term time frames, that's the 4-hour chart, we can start to look at this, that potential, that bias develop on a break of, we've got these lows here, the nearest low is 72.96. That's on the hourly time frame. This impulse, this bullish thrust up, barely penetrated that resistance over here. Not to say that it can't continue up. It might find support in this congestion there. So we'll see how this pans out. It could be an area of support. But if we were to break this level as support, so 73, the round figure. So if we come down and further down, then that's opening risk towards the target we talked about, 72.20 in here. So stages we're looking for this area, which would be seen better on a lower time frame. We might pick some levels from there. So if we take that high there, well, first of all, we're coming into, okay, let's go for this high there. So that's 73.35. Above that, 73.30. So we'll bring that in. Okay. Now the 15-minute trend line is now under pressure. So we're on the backside of the latest bullish thrust. So that's decelerating. We're breaking, not quite. We haven't broken structure, which is here, that candle low. So we want to see a break of that, and we may get a retest back in. So if we were to break, so we've come up, if we were to break this area, and if we had a retest back in, and then heading lower to test these lows, 73, some consolidation around there for the continuation lower perhaps. That's the bearish thesis. A break of 74 would open risks to a bullish market structure to head higher.